All right. Hello, everybody. Thanks for joining today to take a little time out of your day to learn a little bit more about Social Security. My name is Colton Hastings. I'm a certified financial planner with PKS Investment Advisors. And with me today is another associate advisor, Kyle Banks. And we will be walking you through our presentation to learn a little bit more about Social Security. And we're calling it Feeling More Secure About Social Security. And thank you for joining. So to go over a few things that we want to discuss is one, how your benefits are calculated and what goes into that formula. And two, how does the timing of when you claim impact your benefit? How couples can maximize their benefit between the two of them. And of course, we'll go into a little detail on survivor benefits or divorced benefits. So our goal of this presentation is to help you understand the importance of your benefits and making the right decision when you decide to file for Social Security. This can be a key piece for a lot of people's retirement income. So it is not a decision to be taken lightly, and it should be an educated decision when you decide to do so. So one of the issues is that people are really hurting their retirement income by making a costly decision on Social Security. Some people may take the strategy of simply calling up their local Social Security office just to see what their current vested benefit would be at this time. And if they like the number, they may run with it. If it works for them, that is great, but you could run into an issue of you may be forfeiting what you have worked for and a future income that could be much larger. So we want people to take a step back and really think about this before making a decision. So some things to know about Social Security. One is you have a lot of different claiming options. Of course, you can file as early as 62, and you can file anytime between that and your full retirement age. And then you can delay that filing for up to 3 years up until age 70 if your full retirement age is 67. Of course, the decisions have far-reaching consequences. So whether you decide to file early or file late, that will directly impact what that monthly benefit is, and that'll be for the rest of your life. So it is a decision not to be taken lightly. And of course, the system is not bankrupt. That is something that's thrown around frequently. We'll dive into that a little bit today. And keep in mind that not everybody that is currently on Social Security is an expert, whether that's a friend or a family member or somebody at work. Just because they're on Social Security and they feel like they've got a great benefit doesn't necessarily mean that they can give you advice on what you should do. So a couple of the common questions that we received is one, will Social Security be there for me? That is talked about quite a bit. And another question is how much somebody can expect to receive. Of course, that's going to vary from person to person and varies on when they decide to file. And of course, that next question of when should you apply, that's a very personal decision and is not a one-size-fits-all answer. While we will go through different strategies to maximize benefits today, that doesn't mean that necessarily maximizing a benefit is the right fit for somebody depending on their individual scenario. And will Social Security be enough to live on? We will touch on that, but of course, I think a lot of us here know today that it's probably not going to be enough to live on. So, and we just want people to really understand the value of Social Security and make the right decision. It is a big decision on filing, and it is a decision that will impact the rest of your retirement life. So don't take it lightly and make an educated one when you decide to file. So will Social Security be there for me? That's a very common question. So we're going to get into a little bit of the details of the current financial status of Social Security and that trust fund. So some current numbers on the OASDI trust fund balance. In short terms, the trust fund drawdown has begun. So that trust fund balance on 12/31/22 was $2.83 trillion. And you can see that trust fund balance on 12/31/23 was $2.788 trillion. So as the baby boomers are starting to retire and are out of their primary earning years, they will begin to draw down that Social Security trust fund. And you can see here the long-term projections of the OASDI income and the cost of Social Security benefits. Over the next 75 years, costs will begin to exceed the income of the trust. And there are enough reserves that the system will pay 100% of those promised benefits until 2034. After that, if nothing is done with the legislation to improve the scenario, it would have enough to cover 80% of those promised benefits. So a couple of the common proposals for helping to correct the financial scenario of Social Security and the outlook. I'd say the most popular that I hear is the increasing the maximum earnings subject to that Social Security tax. So that's something that everybody pays through their payroll, of course, as they earn. And that currently, the maximum amount of earnings that are subject to that tax is $168,600 for this year. So to a lot of people, that seems relatively low. So that is a common proposal of upping that maximum to a higher number to generate more tax. Another popular option is raising the normal retirement age. For anyone born 1960 or later, it's currently 67 years old. So that is a popular option to increase that age to potentially 70 or somewhere in that range. Discussions have taken place on that one as well. And a couple other commonly thrown around talking points are lowering benefits for future retirees and the calculation on how their benefits are established, as well as the potential for reducing those cost of living adjustments each year that everybody receives. So the bottom line is, and our thoughts on this is, in the near future, your benefits are likely not to be impacted, and more than likely at some point in time, some legislation will be passed to adjust the current scenario and try to improve that. And this is only a few options that we've talked about today as far as potential legislation changes. So there may be other options out there that could improve the scenario at this point. So what's a clear way to think about Social Security? Well, that's what we want to dive into and kind of help establish some talking points on how you should feel about Social Security when you decide to make that decision to file. And one of the key points to keep in mind is this is inflation protected income that you will not outlive. You have paid your premium in every check throughout your working career. So make an educated decision when you decide to file. And the best part is this is, of course, income that you will not outlive. So let's go over a couple numbers just as an example of what your lifetime benefits could look like. So in this example, we're just using a standard $2,000 monthly benefit, and we can look at some of those numbers for 10, 20, and 30 more years. You can see that over 10 years, if you got a $2,000 monthly benefit, you are at $262,793 in benefits. And if you go all the way out to 30 years on Social Security, that's a benefit of almost $1 million at $973,634. And the only increase we're factoring in here is that 2% annual cost of living adjustment. So another thing we want to look at too is what that monthly benefit looks like over time. So you can see that we start out at $2,000 amount. And then over the years, as that COLA adjustment increases that benefit, you can see after 10 years that number is $2,438 per month. After 20 years is $2,972 per month. And 30 years out, if you've received that 2% annual cost of living adjustment, you're all the way to $3,623 a month. So it can really help increase your retirement spending in your budget if you make an educated decision on when filing, because those cost of living adjustments will directly impact what benefit you end up getting when you decide to file. So what can you expect to receive? Let's look at some of the factors that will determine what you will receive in retirement on Social Security. So your benefit depends on a couple major factors. Of course, what you earned over your working career. So typically the more you earned, the higher your benefit will be, up to a certain maximum. And of course, the age at what you decide to file for those benefits. So if you file early, you'll take a hit on your monthly benefit. And then if you decide to file late, you'll get some of those delayed filing credits that we will touch on as well. So how those benefits are calculated, we're not going to get into the formula directly, but to give you an idea of what goes into that formula, at age 62, each year's earnings are tallied up and indexed for inflation. And that's what they go and take your highest 35 years of your earnings and they average them to your AIME. And then that is divided by 3 bend points to determine your primary insurance amount, which is that amount you would be entitled to at your full retirement age. So they take that AIME, split it into those bend points, multiply each bend point by the factor associated with that, sum that, and then that determines your full retirement age primary insurance amount. And of course, those benefits over time would be increased by those cost of living adjustments. So that's all well and good, and I like the idea, let's say you like the idea of waiting until 67 or 70, but for those that don't really quite grasp that and think to themselves, why should I just start getting that income right away instead of delaying until full retirement age or even age 70? Let's take a look at some factors that may impact that as far as your strategy on filing. So one thing to keep in mind is the earlier you file before your full retirement age, of course, your monthly benefit will be reduced permanently. And it also may be reduced further when you hit Medicare age and those premiums are deducted, and if you decide to withhold any taxes from that monthly benefit. So when should you apply for benefits? And of course, this is a very personal decision and it is not a one-size-fits-all answer. But let's look at some of the factors that could impact when you should consider filing. Of course, if you look at the numbers, it says everybody should probably delay as long as they can within reason. But a few things we want to keep in mind and why this is a personal decision is your health status and your life expectancy. If you're in great health and you think you're going to live quite a while, then it probably makes sense to delay and get those delayed credits if you can. But if you're not in the best of health and maybe your family history does not have longevity, maybe it's worth considering filing early and getting those benefits while you can. And of course, that factors into whether you're working or not. If you're going to continue working until full retirement age, and you can live off of your working income, it probably makes sense to wait. But if you're going to cut back work or your health doesn't allow you to do so, you may want to consider filing, just keeping in mind that you will be subject to those earnings limitations. And for those that are married and are both working, those survivor needs, that's something to keep in mind, especially for the higher earning spouse. Their decision on when to file and what amount they receive will directly impact what that survivor benefit may look like. So an age-old question, am I going to be able to live on just Social Security alone? Of course, the answer to that is probably not. Certainly, if you really decrease your lifestyle and you have a paid-off house or you live in rent-free somehow, maybe you can reduce your living expenses to the point where you can live off Social Security alone. But I think for the most of us, that answer is more than likely that's not going to be the case. So let's look at full retirement ages. I think for most of us on here today, it's more than likely age 67. And that's for those of us that are born 1960 or later. But you can see there it tiers down each year for those born before 1960 all the way down until 1943 to 1954, it's age 66. And now we will jump into what if you decide to file early for benefits and what kind of decrease will I receive in my primary insurance amount. So I'm going to use 67 for this example, but you can see there's a chart for full retirement age 66 as well. So if you decide to file at age 62 and your full retirement age is 67, you will only receive 70% of that primary insurance amount that you are entitled to. And you can see that it tiers up throughout the next few years. For example, at age 65, you would get 86.7% of your primary insurance amount. And then, of course, once you hit that age 67, you get your entire benefit that you are entitled to. And on the contrary, what happens if you delay past full retirement age? So you can see here that each year you delay past your full retirement age, you get an 8% annual delayed credit. So if your full retirement age is 67 and you delay until age 70, you're going to get 124% payment of your primary insurance amount. So you get a 24% boost permanently to your monthly income from Social Security. And of course, keep in mind that that higher payment that you delayed until that is going to continually be compounded by those cost of living adjustments as well. So the higher number you can delay till, the higher the number that future benefit may look like because of those cost of living adjustments. So to determine this, how do you get your estimate for your Social Security benefits? The easiest way is to go to socialsecurity.gov, create an account if you haven't done so. There you should be able to get a Social Security statement, and you can even look at your earnings history to see how that looks. So why delay benefits? I want to run through some different numbers to show you some examples of what those delayed benefits can look like and how those monthly payments can be impacted greatly if you decide to delay. So let's take a look at this example. So for here, we're using full retirement age of 67, and that primary insurance amount is $3,000 at the standard. So if you file early at age 62, for example, you can see that benefit is only 70% of what was vested, and you only receive $2,100 without any sort of cost of living adjustments. On the contrary, if you were to wait until age 70, you can see that that benefit without those cost of living adjustments is $3,720. So just by delaying 3 years, you get a $720 per month boost on your Social Security. And you compound that with a 2% cost of living adjustment, you can see that at age 70, you're already at $4,359 on a monthly benefit. So you can see those cost of living adjustments and those delayed credits really give you a nice boost if you have the capacity to be able to delay. So why delay those benefits? It's even more income later on as you get into your later years of retirement. You can see here that if you claim at age 70, you start out at that $4,359 with those delayed credits and the cost of living adjustments. And even all the way at age 80, you're receiving $5,313 a month. That's a great way to provide some lifetime income in retirement that is stable and of course cost of living adjusted. So now we're going into how you can maximize those benefits and what are some strategies to be able to maximize those, whether it's for a single person or for a married couple. What are some ways to think about these things and filing strategies? My associate Kyle is going to hop on and walk through some of those various strategies we can help guide you on.
Thanks, Colton. Hi, everyone. Again, thanks for joining. My name is Kyle Banks, and let's talk about maximizing our Social Security benefits. So applying for benefits at the optimal time, that's the best way to maximize your Social Security benefit. And again, the chief reason for delaying benefits is because that will result in the highest lifetime benefit for both you and for your survivor. But again, there's no one size fits all to answer this question. You really need to kind of analyze this in the context of your own personal scenario. But the important thing is to apply at the time as for optimal as you. And when you're making that determination, you need to consider your income needs, both now and in the future, and then also your life expectancy and also your spouse's life expectancy. Did you know that Social Security benefits are actually taxable? Let's look at maximizing your benefits in the context of minimizing your taxes. So before we talk about the actual tax of Social Security, let's talk about the earnings test. Now, this isn't a true tax, but it is a way that the government takes back some of your income through, withholding your benefits if you apply for Social Security before your full retirement age and you continue to work. So $1 in benefits will be withheld for every $2 that you earn over $22,320 for the current year. Now, your benefit will be adjusted in full retirement. So if you need to continue to work past the age of 62, don't let the earnings test discourage you from working. But to avoid this earnings test, the best way to do so is just to wait until full retirement age or later to apply for those benefits. Now, on to the true tax of Social Security benefits. This table right here, it shows different taxation levels for your Social Security benefits based on various income levels. And an income in this case means provisional income, which is calculated by taking your adjusted gross income plus 1/2 of your Social Security benefits and then any tax-exempt interest. So if your provisional income and is under $32,000 and you're married filing jointly, your 0% of your benefits will be subject to Social Security tax. But if you exceed $32,000 and you stay under $44,000, up to 50% of your Social Security benefit would be taxable. And then if you exceed $44,000, up to 80% will be subject to tax. Now, if you're single, you can see based on this chart, those provisional income thresholds are even lower. And if you're married filing separately and you're living with your spouse, then there is no threshold, just automatically 85% of your benefit is subject to Social Security tax. So let's talk about some ways that we can minimize the taxes on our Social Security benefits. The best way to do so is really just to lower your other income, especially your investment income. You should be aware that municipal bonds, while they're usually tax-free, they do count as part of your provisional income. So you should reduce your other income with other types of tax-advantaged investments. If you have an IRA and you're approaching your required minimum distribution age, just keep in mind that taking those required minimum distributions from your IRA may put you in a higher tax bracket. So you should consider, drawing down that IRA before you reach that R&D age of 73. If you do have an IRA, another strategy that you could employ would be converting a traditional IRA to a Roth IRA so that those investments continue to grow tax-free. Delaying Social Security is another way to minimize your taxes. By delaying, you're reducing the number of years that would be subject to taxation. And like Colton said earlier, planning ahead, reducing your expenses in retirement, pay down debt, adopt a simpler lifestyle, just reduce your expenses to reduce your income needs, in retirement is just good planning practice. And you should continue to manage taxes before retirement and through retirement. And as always, you should consult with a tax professional for your current situation, just to make sure that you're employing strategies that make sense for you. So the other thing to consider here is Medicare may shrink your check. So if you're receiving Social Security and you're 65 or older, you'll be enrolled in Medicare Part B, and those premiums are deducted from your check. So in 2024, the Medicare Part B premium is $174.70. So let's look at that in an example, how that impacts your check. So let's assume an individual has a primary insurance amount of $2,600 and their full retirement age was 67. So the earlier they claim, the more that Medicare Part B premium eats up their check. So if they claimed at age 62, they're only getting a 70% of their PIA benefit, which would be $1,820, and that Medicare Part B premium will be 9% of their check. Now, if they waited till full retirement age, that Medicare Part B premium would only be 6% of their check. And if they delayed even further to 70, now we're only looking at Medicare Part B being 5%. So the earlier you claim, the more that Medicare premium is going to eat up the amount that you actually receive. So when to apply, this is a question that becomes very complex. And again, it really requires, a customized analysis where, you can think about all the factors that are unique to your situation. But as general rules, here are a few key points for you to remember. If you apply early, your benefit starts lower and it stays lower for life. And as Colton said earlier, cost of living adjustments will magnify the impact of either claiming early or delaying. If you delay, those cost of living adjustments compound based on a higher number. So keep that in mind as you're making the decision. Your benefit may be reduced for your Medicare premiums, and it will also be taxed. So just make sure that you're practicing good tax planning, in the context of when you claim. And don't let the earnings test discourage you from working. In many cases, if people continue working past age 62, they can continue to improve their earnings record. And delaying benefits may give the surviving spouse more income. We're going to talk about this in a little bit more detail in future slides. But when you're making decisions, it's always important to make sure that you're maximizing benefits both for you and for your spouse. So we'll dive into that in a few slides in more detail. So you may be asking, I don't expect to live that long, so why shouldn't you just claim your benefit when you can? Maybe you have health issues, you don't have longevity in your family. So the typical answer to this question, particularly for couples, is you should always maximize the higher earner's benefit to protect the surviving spouse, because they'll step into that benefit when the higher earner passes away. So higher earning spouses are therefore encouraged to delay benefits until age 70, because that gives their spouses the highest benefit after they die. But before we get into surviving benefits, let's talk about spousal benefits and how they work. So spousal benefits allow a lower earning spouse to, rather than claiming on their own working record, claim the spousal benefit, which would be 50% of a higher earning spouse's primary insurance amount. So essentially what it does is, if you have a spouse that, maybe stayed home for part of their working years, cared for children, it gives them a little bit of financial protection in retirement by allowing them, rather than claiming on their own record, to claim on their spouse's record and potentially receive a higher benefit. So let's look at an example of this. We have John and Jane. They're married, and John's primary insurance amount is $2,000 per month and Jane's is $800. So if Jane applied for Social Security at full retirement age, she would be eligible for a spousal benefit of $1,000, which is 50% of John's primary insurance amount. So she would claim that rather than claiming on her own working record, and she would be entitled to an additional $200 per month. So a few rules to consider when we talk about spousal benefits. In order for a spouse to claim that spousal benefit, the higher earning spouse, the primary worker, they must have already filed for their benefit. And the spouse must be at least 62 to claim that spousal benefit. And again, similar to claiming early, if you claim on your own record, the benefit will be reduced, and it is reduced up until full retirement age. So, if a spouse claims anything before full retirement age, they won't get that full 100% spousal benefit. Now, one thing that's different for spousal benefits versus claiming on your own working record is there are no delayed credits. So there's no benefit to claiming a spousal benefit past that full retirement age. So with that in mind, let's look at a few ways that you can maximize benefits for a couple. So again, if you're a married couple, coordinating your spousal benefits is very, very important because you want to maximize the income for both of you while you're alive, as well as the surviving spouse when one of you dies. And that can be quite complicated. So you really need to understand the calculation and kind of understand it in the context of your financial situation to understand what works for you as a married couple. So let's look at a few general strategies here. So the first thing that you want to look at when you're coordinating spousal benefits is the decision really comes down to, is the lower earning spouse's primary insurance amount more or less than 50% of the higher earning spouse's primary or PIA? So if the lower earning spouse's benefit is more than 50%, meaning they would not be eligible for that spousal benefit, if the goal is to maximize benefits for both spouses over both lifetimes, both spouses delaying until age 70 would do that. And our calculators show that, this would be the most optimal scenario for spouses that have an average or longer than average life expectancy. And that allows you to maximize your benefits over both lives. Now, if you have a scenario where a lower earning spouse's primary insurance amount is less than 50% of the higher earner's primary insurance amount, then you could employ what's called a hybrid strategy. This would be where the lower earning spouse would go ahead and claim early at age 62. The higher earner would delay until age 70. Again, we want to maximize the higher earning spouse's benefit. And what this basically allows you to do is generate income sooner while maximizing the higher earning spouse's benefit over both lifetimes. So again, these are just a few general scenarios. Everyone can really benefit from a customized analysis. You really need to kind of think about what works best for you. Everyone has unique scenarios, unique financial needs, and that's where we can help. We are happy to sit with you to help you understand what makes sense for you and for your spouse. As you approach retirement, or maybe you are already retired. Just understanding how to maximize that benefit in a way that makes sense for you. So we've talked about spousal benefits. Some of you may be saying, well, I'm widowed or I'm divorced. How does that impact my Social Security claiming strategy? So if you're widowed or divorced, you may be eligible for survivor benefits, a divorced spouse survivor benefit, or a divorced spouse benefit. And by coordinating these benefits with your own working record, you may be able to increase your total benefit amount. First, let's look at basic survivor benefits, and then we'll move on to divorced spouse benefits. So survivor benefits are somewhat complicated, but there are two key factors to consider when you're thinking about what the survivor benefit will depend on. And the first being the age at which the deceased spouse originally claimed their benefit. So if the deceased spouse claims prior to full retirement age, then the survivor benefit will be limited to either the higher of that deceased spouse's benefit or 82.5% of the primary insurance amount. Said another way, if the deceased spouse claimed early, then the surviving spouse will get a lower amount than the primary insurance amount. And if the deceased spouse claimed after full retirement age, then that survivor's benefit will include the delayed credit. So again, this comes back to maximizing the higher earning spouse's benefit over both lifetimes. The other factor is when the widow or widower would actually go ahead and claim that survivor benefit. If the survivor benefit is claimed before full retirement age, then the survivor benefit will actually be a fraction of the original benefit. So survivor benefits can be claimed starting at age 60, or it's age 50 if the surviving spouse is disabled, but it'll be reduced. So at age 60, it would be 71.5. And if the survivor claims at full retirement age or later, then the benefit will be equal to 100% of the original benefit. So again, there's no delayed credits for the survivor waiting past full retirement age to claim that benefit. So let's look at a practical example of this. We have a married couple, Joe and Julie. Joe's monthly benefit is $2,800. Julie's monthly benefit is $1,500. Both of them are over full retirement age. When Joe passes away, Julie can notify Social Security, and her $1,500 per month benefit will be replaced with a survivor benefit of $2,800 per month. Now, one important note for survivor planning is while the surviving spouse can switch into the higher benefit, it still is the loss of one benefit. So Julie will not continue to receive her benefit plus Joe's benefit. She'll just get the higher of the two. So when we think about this from a planning perspective, it's important to kind of plan for this from an income need perspective to cover expenses in retirement, as it still represents a loss in income, just it allows the surviving spouse to switch into the higher of the two Social Security benefits. So let's take a look at that same example, but let's illustrate the power of delayed claiming. So we're going to look at the same scenario that we looked at on the prior slide. If Joe delayed claiming until age 70, then his benefit would be 124% of $2,800, meaning he would get 8% delayed credits for the 3 years that he delayed claiming from his full retirement age. That would take his monthly benefit of $2,800 up to $3,472 per month. So when Joe passes away, Julie's survivor benefit is now $3,472 per month rather than $2,800 a month. So again, this goes back to what we've been, commonly saying through all these slides: maximize the higher earners benefit over both lifetimes. So here are a few rules to consider when we're talking about survivor benefits. In order to be eligible for survivor benefits, the couple must have been married for at least 9 months, with the exception being if the death of the spouse was ruled an accident. In order for the survivor to claim the survivor benefit, they must be at least age 62 or 50 if disabled, and they can claim up to full retirement age. Just keep in mind, if you claim at 60, then you're getting a reduced benefit, and that will scale up as you approach full retirement age, similar to your own benefit would. Survivor benefits are not available to the widow or widower if they remarry prior to the age 60. And again, 50 is the exception for a disabled survivor, unless that marriage ends. So if someone did remarry prior to age 60, they would no longer be eligible, but they could become re-eligible if that marriage ever did end. And survivor benefits are available to a divorced spouse, with the rule here being that the marriage must have lasted for at least 10 years. So let's move on and talk about divorced spouse benefits. Divorced spouse benefits are the same as spousal benefits. If the marriage lasted for 10 years, the person receiving that divorced spouse benefit is currently unmarried. So again, you can't claim a divorced spouse benefit if you get remarried. And the ex-spouse has to be at least age 62. They don't have to have claimed their benefit yet, but they have to be at least that age. And then if the divorce was more than 2 years ago, then that ex-spouse does not need to have filed for benefits. So that's the other thing to consider here. So a few more rules when we talk about divorced spouse benefits. More than one ex-spouse can receive benefits on the same worker's record. meaning as long as all the other rules are satisfied, if an individual has been married multiple times, multiple ex-spouses could claim on that same person's record, and multiple people could receive divorced spouse benefits. The benefits paid to one ex-spouse, they don't impact the benefits that are paid to that primary worker, and they don't impact the benefits that are paid to any other ex-spouse that's also claiming that divorced spouse benefit. And again, divorced spouse benefits stop upon remarriage of an individual, so you cannot get remarried and then continue to claim that divorced spouse benefit. So divorce spouse and survivor benefits are extremely complicated. And again, this goes back to why you need to have a customized analysis to really make sure that you're understanding all the nuanced rules and how they impact your decision of when to claim and how much you'll get. So let's revisit the problem that Colton had talked about earlier. People are hurting their retirements by making costly decisions about Social Security. There are a lot of rules. There's a lot to consider, and there's a lot of moving parts. Social Security is just one piece of your retirement. You need to make those decisions in the context of your income needs, your health, and your other assets. So a few key insights that we talked about earlier: your Social Security benefit offers inflation-protected income. I've heard it referred to as longevity insurance. You cannot outlive that benefit. If you live to age 90, 95, 100, you will continue to receive that Social Security benefit. When you claim impacts how much you'll get. Your benefit is reduced if you claim early. And if you delay, you'll receive more. Couples should always maximize that higher earning spouse's benefit to protect the surviving spouse and allow them to get more income. And if you're widowed or divorced, you may be eligible for benefits that can increase your check. So when, if you're in that situation, you may be just kind of thinking about Social Security in the context of your own working record, but you need to consider it in the context of these benefits, because you could increase the amount that you get each month. So everyone needs a personal Social Security claiming analysis to understand, when to apply, how to apply, and how does it fit into their overall retirement plan. And that's something that, we're able to help with. And when we help people with this decision, we're helping them make that decision in the context of their pensions. Any IRAs or 401ks, particularly, those RMDs, the required minimum distributions that are going to start at age 70, any investment assets that they have, and then if they're going to continue to work. Again, this is a multi-step decision, and there's a lot of factors to consider. So one thing to keep in mind, if you call the Social Security Administration and you talk with Social Security personnel, they're limited in the ways that they can help. So just make sure you understand that if you do have a conversation or meeting with anyone that works there. What they can do is they can estimate your individual benefits, and they can tell you how much you're entitled to right now. What they don't do is they don't project future benefits through any sort of like scenario planning, break-even analysis, and they cannot help with innovative strategies to make sure that you're maximizing benefits both over your life and your survivor's life. So I'm sure you have questions. We can help. If you're thinking, when should you apply? What if you want to keep working? If maybe some of you have already applied and you're thinking like, okay, now that I've already applied, is there anything I can still do to make sure that I'm, making the best decisions to maximize benefits going forward? How much will your benefit be? How can you coordinate benefits with your spouse? Again, this is a very complicated piece of Social Security, and we have resources to help make this decision a little easier and provide you with like visuals that should make it a little more clear. What is your best long-term strategy, and what should you do next? Maybe you're approaching Social Security age, or you're still working and you're thinking, down the road, how do I initiate this? When should I start thinking about this? We're here to help. Social Security is too important for guesswork. So let us provide you with a custom analysis. Anyone that's on this session today, we're offering a complimentary 1-hour service. We will review your scenario, and we'll provide you with a, evaluation and help you have a little more information to make a decision that works best for you and your family. So at this point, we'll pause for questions. If you have any questions, feel free to go ahead and put them in the chat, and we're happy to answer them. If you'd prefer to ask them after, we'll provide our contact information, and you can ask them that way if you feel more comfortable. But I guess I'll pause for a second to see if there are any questions. Okay, well, I'm not seeing anything. So if you do have questions or you think of them after this presentation, please reach out. We're happy to help. We're happy to, if you are interested in a custom analysis, we're happy to provide that. But we really appreciate everyone attending. We hope that you learned something, and that it's something that you're able to apply as you're making a really big decision for your life. Colton, did you have anything you wanted to add?
Yep, I just wanted to say thanks for everybody for coming out, and we will follow up this presentation with a follow-up email for those of you that would like to ask a question directly. We can be contacted via that follow-up email with all our contact information. Thanks so much.
Thanks so much, everyone.
Take care.